Bismillahirrahmanirrahim. Assalamu alaikum everyone. My name is Yasir Yamin and I welcome you all in this session. My friends, the topic that I'm going to discuss today should be of interest to both students of FR and FM. Now, this is one area where students usually lack, very good skills. They lose marks in this area, and our whole session is going to focus on how can you improve yourself in this area and gain good marks. From my perspective, I'm going to divide this topic into two basic strategies. Yeah. So my first strategy is that I'm going to teach you what basically ratios are, what is their use. Yeah. So we are going to focus on the technical element, for at least the first part of this lecture. And then the other part will focus on how to comment in your exams, the exam strategy. So with this two-step strategy, we are going to learn about this very important topic, which is mandatorily examinable in your exams. All right. So let's move forward. Let us first discuss that how interpretation of financial statements is supposed to be done. Now, financial statements are something which all accountants rely on. All investors also rely on them. But the whole idea is that through financial statements, investors, potential lenders, our creditors, our potential investors, they want to assess the performance of the company. And not only the performance based on profitability. They want to know if we are liquid enough to pay off dividends. They want to know if we are, if we are maintaining our risks profile very well or not. What about the debts that we take in order to keep ourselves liquid? Multiple investors also want to know how we are managing our working capital cycle. So when you talk about various stakeholders, they have various questions in their mind. Now, one strategy could be that each and every stakeholder, like, company's own management or the board of directors or the accountant or the external stakeholders, the one strategy could be that they could pick up their financial statements and start studying financial statements on their own. Now, although this is a very fine strategy, but it will take a longer time to reach conclusions. And many of the stakeholders may disagree based on their interpretation. If it's left up to stakeholders to interpret the results, the meanings of the financial statements on their own, every person will come out, will come up with their own conclusions. And nobody will be right and nobody will be wrong. So actually, we need a standardized strategy to assess the financial performance of an entity. And for that very purpose, we use ratios. So ratios is basically a strategy which allows us to study or to appraise the financial performance of a company based on a standardized manner. Overall, there are 5 categories of ratios that we will focus on. These are the ratio categories that are included in our course as well. So one category is profitability ratios, or commonly known as performance ratios. The other category, the second category, is basically liquidity ratios, the current ratio, the asset test ratio. I know that you know about this. The other type of category is working capital ratios, or commonly known as efficiency ratios. Fourth part, gearing ratios or long-term solvency ratios. Number 5, investor ratios, or known as stock market ratios. So we have 5 categories of ratios that help us in assessing a company's financial performance. Now, while we have been discussing about ratios, you must be thinking, what actually are ratios? Ratios is basically a mathematical term whereby you take one variable and weight it against another. So if you are taking A over B, this is basically a mathematical ratio, and that maths that you used to study in your primary or secondary, that mathematics is going to help us in appraising the financial performance of an entity. Yeah. All right. So we'll start up with profitability ratios. By all means, specifically in the FR exam, profitability ratios are one of the most important ratios from your examination point of view, because these are the ones that are mostly tested. For FM, for financial management, all of the ratios are important, but for FR in particular, profitability ratios are of prime focus. Let's move forward. When you talk about profitability ratios, from my perspective, the most important ratio that you can think of is basically return on capital employed. Now, return on capital employed, or commonly known as the ROCE, is a very important ratio. ROCE is calculated as follows. The formula for ROCE is that you take profits before interest and tax in the numerator, you divide it by the capital that has been employed in the business, and you multiply it by 100 just to get a percentage. Here, the capital employed is calculated as, it can be calculated by one of the two formulas. The first formula can be used, which is total assets minus current liabilities. Or it can be calculated with the second formula, which is equity. Equity means share capital plus all reserves, equity, and you take on the long-term debt, long-term liabilities. Yeah. So the whole idea is that whenever there is a business which is a going concern business, it is a running business, it needs money to operate. So the investors, either the equity holders or the debt holders, they provide funds to the company in terms of capital being employed in the business. And what they want to see is that what amount of money we invested, and in that amount of money, how much profit did we make. So profit before interest and tax divided by capital employed tells the investors or the business that what amount of return has been earned on the amounts that had been invested in the business. So it's a simple common sense phenomenon, return on the capital employed. So I'll start my lecture with telling you some important notes about this ROCE. First of all, ROCE, remember, is the primary indicator of profitability of the business. It is the primary indicator of profitability. If anyone asks me, sir, what is the most refined or what is the most finest ratio through which we can conclude whether the company has performed good or bad, I would always say ROCE. Because ROCE actually tells the investors that what amount of money had been invested and what return on it has been made. If ROCE is better, everything is better. If ROCE is not better, everything is not better. Yeah. So nothing at the end of the day matters if the business is not running profitably. So the whole idea is that whenever you are trying to appraise a going concern running business, return on capital employed is the most primary indicator of profitability. Through this, you can essentially conclude if the company has performed well during the year or not. But remember it, this is a very important point. ROCE is a strategic measure. ROCE is a strategic measure. It is not an operational measure. It is a strategic measure. Now, ROCE always tells you whether the company has performed good or bad. So, for example, if your examiner gives you two types of return on capital employed. Let us say X2 return on capital employed comes up to be 20%. Whereas when you compare this return on capital employed of this year with the previous year's one, you see that last year it was 15%, this year it is 20%. Now, just like that, you come to the conclusion that the performance has been better than last year. Yeah. But remember, through this analysis, you only get to know about the strategic actions that the company has taken. Whether the company was successful, yes or no, it's a one-point conclusion. How was the year? It does not tell you why was it better than last year. What did we actually do this year in order to cope up, in order to improve our profitability this year? This ratio does not tell you. So this is a strategic measure. It is a strategic measure. Yes, it can be used to make a comparison with other companies. to assess if the investment is really viable for investors, yes or no. So maybe, for example, you are a company and you compare your return on capital employed with the return on capital employed of your competitor, of any other company which is in the same industry. So for example, you are earning 10% and the other competition is earning 8%. So you at once know that you are performing better than others. This may be due to proper management of the company's capital that has been put into the business. It can be vice versa as well. For example, you have an A company, and then when you compare it with the industry averages, the industry benchmarks, so the whole industry is earning 15% of return on capital employed, and if you're earning 10%, that's poor performance. But the whole idea, the whole point that I'm trying to make is that you never go into the nitty gritties of profitability or the operations when you're talking about ROAS. It is a strategic measure, it is a strategic ratio, and therefore you need to compare the strategic ratio, this ratio strategically. You compare it with other companies, you compare it with the target return on capital employed that had been provided, you compare it with industry averages or any other thing. But you do not go into the basics of profitability. That's not the whole objective of calculating ROAS. Remember, the assessment of ratio should be based on controllable factors. Now, this is very important. And specifically from a financial management perspective, yes, or also from a financial reporting perspective, but also from financial management perspective, it's very important that if you are appraising the performance of your directors or the board or the company's senior management, it's very important that you base your appraisal based on controllable factors. It won't be fair. For example, if your profit before interest and tax includes such factors which were uncontrollable during the year, there is no point in assessing their performance based on uncontrollable factors. So it's very important that you use controllable factors for the purpose of performance appraisal. Otherwise, it won't act as a business target. Sir, we don't actually understand what point you are trying to make here. I'll just clarify my point. Just think, for example, there is an A company. They had a gross profit of 10,000, and then there was a one-off disposal loss of $5,000, due to which their profit before interest and tax came up to be 5,000. And just imagine if their capital employed was 50,000, they would have earned a return on capital employed of, somewhat 10%. But you need to assess the company's performance, in the right manner. Here, it is quite evident that the profit or loss account includes a one-off expenditure. You cannot base the appraisal of your management or your senior management or your board of directors based on a one-off expenditure. One-off expenditure may had been due to any, some sort of impairment. One-off expenditure, may have been due to the fact that the machine was idle and they wanted to sell the machinery even at even if it was sold at a loss. They wanted to sell the machinery so that they could make sure that they have enough space in their factory so that they can run their operations smoothly, or they wanted to make sure that they get the optimum price for their idle machinery right now, and do not risk losing more money and having more loss on disposal in future years. This may be a good decision, but again, you need to consider this fact that this is a one-off loss and it won't continue into the future. You cannot appraise your management's performance based on one-off expenditures, right? So if I had been in your examination, what I would have done is I would have taken this PBIT calculated as 5,000. I would have added back this one-off expenditure, and I would have come to the controllable profit level of 10,000, and I would have calculated a ROAS of somewhat 20%, the double. So in your exams, you need to think carefully. If you ever see that there are some uncontrollable factors that have been built in either to my profit before interest and tax or the denominator, what I would do is I would first say that okay, the return on capital employed was 10%, which is relatively higher as compared to the previous year. However, if we add back the one-off loss on disposal and then we calculate ROCE, it would be 20%, which is far more impressive performance as compared to the previous year. Now, this is how you comment. So it's very important that you appraise the financial performance of your company based on controllable factors and not uncontrollable factors. Yeah. Moving on. What factors could you see while you are appraising performance through ROCE? Oh yes, I do understand that anyone would have had this thought. Whenever you are comparing the performance of ROCE, either from previous years or from another company or the industry averages, you should keep some things in mind. What could have affected your PBIT? What could have affected your capital employed? What could have affected these numerators or denominators? Now, there are some accounting factors and there can be some business factors. I would like to distinguish between these two. Sometimes return on capital employed of the company is looking not so impressive just because there are some accounting adjustments that have been made into the financial statements, and that is why it doesn't look good. And sometimes there are some genuine business reasons because of which the company was, due to which the ROCE was not well. And the company's board of directors or the senior management is liable to answer for, not a good performance. So you need to look at both angles from an examination perspective. So some of the accounting factors that you could highlight while you're solving your examination question is, so for example, if your P&L contains fair value gains or losses, heavy fair value gains or losses. So for example, it is quite possible that when you see an examination question, you see that there are high fair value gains in your profit or loss account. Now, what that would have done is, if you have fair value gains, your profit, your PBIT would have been higher. If your PBIT would have been higher, this would have resulted in higher ROCE. And here you can comment that the return on capital employed was essentially higher due to higher fair value gains. But excluding these fair value gains, the performance was not so well. You can recalculate your ROCE in the narration of your answer and say that, okay, once I adjust this, fair value gain back, the operational performance was not so well. You can think about it, in a vice versa manner as well. So for example, in 1 year, you see that there are heavy fair value losses because of which you see very low profit before interest and tax. You can just say that had this been not the case, the profit before interest and tax could have been higher. You can say that. Whenever you are looking at a question, try to find out the anomalies. So for example, you see a heavy research and development expenditure, and you see that the return on capital employed this year has gone down. You can just comment very easily that the research and development expenditure that has been written off during the year has diluted the return on capital employed for the year. But for sure, if this research and development expenditure moves on to a later stage and a real life future economic benefit product is developed, it will benefit the company in future. So today's research and development will give you future economic benefits, right? So you can make up a case in your examination that due to this R&D, the profit was low, but future is bright. You can write this into your interpretation. Look out for recognition of leases. Yeah. So you and I both know that if you have studied IFRS 16, you and I both know that, most likely all leases will nowadays be classified as long-term, or rather I would say as finance leases. Now, there can be a possibility where the company has entered into a lease agreement just before the year end. So if the company has really entered into finance lease agreement just before the year end, that would have inflated your capital employed. But since the lease was just taken by the year end, there are no true economic benefits of that lease coming into profits this year. So there is no or less impact in profitability, but there is whole lease impact in your capital employed, the denominator, and therefore the rows would have been affected. Now, if you find a lease agreement in your question, then you should, think of writing such a scenario. Yeah. Always remember that when you're writing an examination answer for ratios, you always use the word maybe, can be, shall be, could have been. You use these words. And why is this important? Because when you use these words, you're telling to your examiner, you see, these are the possible causes or the probable causes of such a deviation. I cannot confirm. I mean, in your examination, you are not facing a real life company. You don't have real life data. You don't have real life time to figure out the data. So what you can just do in your examination is to just find out the right words and to use the right words. And that could be maybe, shall be, can be, could be. So this implies the fact that whatever you're telling based on the limited information that has been provided in the examination question, but there is no surety that this would have, resulted specifically due to this reason. Yeah. Then there can be excess depreciation arising due to revaluation. I remember that I was, once in our class, we were doing a ratios question and there was a balance sheet given. And there we saw that in the last year, the revaluation reserve was 0. And this year, the revaluation reserve was higher. Yeah, so there was a massive revaluation done during the year. It was written in the adjustment notes that the company follows excess depreciation technique for charging of the, depreciation revaluation. And that came up to my mind. You see, if you see revaluation reserve in your question, that could have led to excess depreciation. And if that could have led to excess depreciation, maybe your profits could have, would have diluted. Yeah. So some of the reasons, and, moreover, if you are exposed to revaluation during the year, your total assets would have increased and therefore your capital employed would have increased and therefore your ROAS would have fallen. So revaluation in itself has an impact on the return on capital employed. Now, these are some of the accounting adjustments that you can always refer to when you're writing an examination answer. Always try to figure out such things. Now, one of the worst things that I, sometimes see in people's answer is they know that they can use the words maybe, can be, shall be, could be. And you know what they do is they just write their answer theoretically. You see, I'm just saying that I just told you that you need to, whenever you write an answer, you need to say that I'm not 100% sure of something. I presume that this would have happened. Yeah. But then even if you're proposing that the ROAS has fallen maybe due to leases, first you need to figure out in the balance sheet if there are any non-current liabilities, and in those non-current liabilities, if there is a lease. If you have been given a balance sheet and in the balance sheet you do not find any finance lease obligations, and then you write in your answer, sir, that return on capital employed might have decreased due to the impact of lease recognitions, you won't get a mark. Because there was no hint in the question that could have led you to this conclusion. Yeah. So you cannot just write an answer just from your own thought process. No, you need to trace out things like these and many more things that come into your questions. You need to trace out some specific accounting accounting frictions or accounting balances through which you make up your assumption that this would have happened. But if you don't find anything in your question, do not try to invent things in while you write your answer. Do not try to invent things. Yeah. For example, if you do not find anything about research and development in your whole question, there is no point writing this point. There is no point in writing the fact that maybe ROAS has fallen due to research and development expenditure. There was no hint in the question. Do not write such statements if there is no hint to the same. Yeah. But again, not only accounting factors do we have, but there will always be some business reasons in the question that you need to figure out, that you need to trace out. Yeah. So for example, just have a look at it. Is competition rising? Maybe your return on capital employed is falling because you're not able to keep up with your prices, just because it's a highly competitive industry. There may have been some new entrants into the industry, and they are pushing down your price levels, and they are pushing you to spend a lot into marketing expenditure. They are pushing you a lot to squeeze down your margins, and that is why maybe your return on capital employed would have fallen. Now you need to trace out if there is any evidence in the introduction or the basic part of the question that gives you the hint that there was fierce competition. Sometimes your examiner gives you such an industry for which it is pure common sense that this is a very competitive industry. For example, sometimes I've seen such questions where your examiner says that XYZ company is in the fashion industry. Now, fashion is very competitive. You can write it on your own that competition may be very fierce, due to which the return on capital employed may be falling apart. Maybe the company is not able to keep up with its prices, or is not able to control or tone down its marketing expenditure. They want to keep themselves relevant. It's all about not earning enough return on the capital employed just due to competition. But again, you need to trace out if there is a hint of competition given in the question. Yeah. Then, how's the economic environment? Focus on this fact. Why might the ROAS be increasing? Why might ROAS be decreasing? Is the economy going through a boom? If the economy is going through a boom, most likely you will see a raise in your return on capital employed as well. Because all of the capital would have been employed into the business some years back. And if there is a boom economy going on, you like many others would be earning high profits. So high profits on a capital employed which had been contributed 5 years before, already been depreciated based on the old price terms, definitely your return on capital employed would increase. But you just need to see if there is a hint to the fact that how the economy is moving. If the economy is not moving well, your return on capital employed should go down, because your profitability won't be much in tough times. You need to see this in your examination. Just connect environment. Just see if there are any factors they are beyond company's management control. So if you find any area which is beyond the control of or beyond the control of entities management, then you should point out such factors that, see, okay, the return on capital employed has fallen, but these factors were the major contributing factors which were more or less uncontrollable by the company's management, and therefore they cannot be appraised based on such an answer. If we add back these transactions and then we see the return on capital employed was much higher. Yeah. So you need to make up a case in your examination just to make sure that you comment very appropriately. Then, has there been a recent acquisition or disposal? Always look out for such information, because whenever you acquire a company, you incur cost of business combination, and that is all to be charged in your P&L, which could have diluted your this year's profitability. It might have been an unexpected expenditure. So unexpected expenditures drive down your profitability and eventually the ROAS. If, for example, if you see in a question that there has been a disposal of a subsidiary or something like that, so subsidiary or maybe an assets disposal create gain or loss. Again, this is a one-off impact. Why won't you just add back or less, or net of the impact of this gain or loss on disposal, and then calculate a controllable ROAS? Why won't you do this? Yeah. So overall, what I want you to do is, we are going to talk about how to make up your answer. But what I want you to do is, whenever you see ROAS, first of all, look out if it's improving, if it's going up, or if it's going down. First of all, your second step should be to assess that if this return on capital employed will increase or will decrease in future. Yeah, then you need to figure out why this return on capital employed would have increased or decreased. And in that perspective, you always have two areas. You look out for accounting factors, and you also look out for business factors. Accounting factors like lease recognitions, revenue recognition, major investments in plant and machinery just by the year end. And there may be some business reasons as well, just like competition, customer perception, and so on and so forth. You need to mix up these two areas and then write up your answer. This is all for ROAS. Now moving forward. As we move forward, there are two further ratios that I need to discuss. The first ratio that I'm going to talk about is basically gross profit margin, or in short known as GP margin. Yeah, GPM. Now the formula for gross profit margin is that you take your gross profits in the numerator and divide them by sales into 100. Yeah. So basically what this ratio, gross profit divided by sales into 100, tells you is that how much gross profit is generated as a percentage of sales. So for example, if you get a gross profit margin of 20%, it tells you that on every 100% sales that you make, any sale that you make, 20% is your gross profit, or 40% is your gross profit, or 50% is your gross profit. Yeah. So you know that your gross profit is not your final profit. So the higher gross profit margin you have, the more likely are the chances that you get a net profit. So basically always remember that gross profit only denotes the product profitability. I've often seen that what students do is that while they are commenting on gross profit gross profit margin, they start talking about, poor administration of expenses and, poor cost control and things like that. No. Gross profit margin literally only talks about the product's profitability. The whole idea is that the company should have a high gross profit margin, so they have a potential to have a good bottom line as well. Yeah. So for example, if there is a company, God forbid, if that company has a negative gross profit margin of 5%, what would I say to this company? You see, gross profit margin is the product profitability. If the product in itself is selling at a loss, there is no other way the whole business can come at a profit. You see, for example, I teach you guys. If my teaching in itself is not so well prepared that I make a margin on my teaching services, then how the hell I can make, how would that be possible that I make an institution profitable? If my teaching in itself is in loss, the whole institution would be at loss. So always remember, it's quite essential for companies that they generate a good gross profit margin, on their products, so that at least they have a potential to make a profit someday or the other day. Even if they are not making a good net profit now, they can make it in future, because as the volume will grow, the profitability will grow, and whenever you have a fixed cost impact in your selling and general administrative expenses, those will start to recover up once you have the volume, and thereon you will have a good bottom line. But if you have a negative gross profit margin or a very low gross profit margin, you won't be able to survive. That's the whole idea. All right. So please make sure that you talk about only the product profitability while you're talking about GP margin. The other thing that I always want to highlight while I'm teaching GP margin is, please do only discussion on prices and not volumes. People are wrong when they talk about volumes while discussing GP margin. No, it's wrong. Why? I'll explain it to you. So for example, there are two cases. In the first case, let us suppose the company only sells one product. The selling price is 100. The cost, for example, is 60. So they make a gross profit of 40. Now here your gross profit margin will be 40 divided by 100 into 100. So that makes up 40%. Yeah. Now, for example, this company goes on to sell two products. So higher volume. It's not selling one product, but two products. The revenue would double. It would become 200. But at the same time, your cost will double as well. 60 will become 120 most likely. And thereon, in absolute terms, you will have more profit, and that would be of 80. But now if you divide 80 by 200, you will have the same answer of 40%. You will have the same answer of 40%. Now the point I'm trying to make is that volumes do not impact your GP margin. Volumes do not impact your GP margin. GP margin is simple gross profit divided by sales. How much profit do you earn as part of your sales? Now, as long as you're not talking about a very big voluminous growth, which actually brings you economies of scale, most likely volumes will not be connected with GP margin, because even if you sell two products instead of one, still the GP margin is going to remain the same. So please do not talk about volumes, talk only about prices. Now, if the GP margin is increasing, most likely the prices are increasing because you are earning more margin by selling your product. Or you might be better in controlling your costs. Yeah. So you might have received a bulk discount from your suppliers. You might have reduced the operating cost of your production. You might have brought down the production cost of an item. That is why your GP margin might have increased. But please focus on price or cost. Nothing except that. Yeah. This ratio can be used to compare with direct competitor and past periods. When you compare your GP margin of one company with the other company, for example, your GP is 30%, whereas their GP is 20%, it makes an easy base case. It makes an easy investigation case that, how the hell are we better? It is an easy case because we have more efficient production, because we charge higher prices, and that is why we may be having higher gross profit margin. You always need to compare your gross profit margin with your competitor to set a benchmark in your mind that are you at least performing better than your competitor or not. Yeah, it's a basic standoff. Yeah. You can also compare your gross profit margin, with your own past periods, for example, X2 versus X1. So for example, in X1, if you had 10% GP margin and now you have only 5% GP margin, it's approximately a 50% drop. So here you should trace out what can be the potential reasons of this drop. We'll talk about the reasons, just in a while, but at least this comparison with past periods tell you that something is not right. Yeah. And what cannot be right? Just figure out the reasons. Just like before, there will be accounting reasons and there will be business reasons. So let us just first focus on accounting reasons. So accounting reasons can be this is quite a common phenomenon in FR examination questions, that there are some reclassification of expenses. So for example, what happens is your examiner gives you this scenario, X2 financials, X1 financials. So for example, there is sales, there is cost of sales, then comes GP and then expenses and so on and so forth. So for example, in last year, the sales was 100, cost of sales was 50, the gross profit came out to be 50 and the expenses were 10. So at the end of the day, you had a net profit of 40 or something like that. Now here the GP would have been 50%. Yeah. 50%. 50 divided by 100 is 50%. Now in X2, you see that your sales are the same, for example, 100%. And now you see that your cost of sales has, risen up to 60%, 60. Your GP is 40, and here you have no expenses. For example, again, you have a net profit of 40, but you would have a lower gross profit margin if you calculate, though that would be 40. Now, there is quite a good possibility that the company has adopted reclassification during the year. By the way, if the company adopts reclassification during the year, it should adjust its financial statements retrospectively. But however, there can be a scenario where your examiner gives you this case and tells you that, sorry, the company had done some reclassification during the year, and due to which some expenses which were previously charged under gross profit, they have been put into cost of sales to affect gross profit. So the overall profitability remained same, but this particular ratio is now affected. Last year it was 50%, this year it is 40%. Yeah, there may be a reason of reclassification due to which your gross profit levels may have got affected this year. There may be some errors or omissions due to which your gross profit would have been affected. Yeah. Now, while we are discussing gross profit margin, my whole focus would be more on the business reasons. For me, business reasons are more important right now when you're talking on an operational ratio. So business reasons that you can look at. Just look at if there is an increase or a decrease in the direct cost of operations. Is there any hint into the examination question that gives you the idea that overall material cost has increased, or the economy is facing an inflationary scenario and a recession scenario due to which the operating cost would have increased. Now these are the reasons that your examiner won't tell you them himself. Your examiner will tell you that there is a recession going on, and the people are protesting against high prices. Now you need to pick up that point and see if it connects you with your lower gross profit margin. Obviously, if there is a recession and the prices are high, most likely what will happen is that your cost of sales will increase because your raw material would be expensive, your labor would be expensive, your overheads would be expensive, and as a result, your gross profit margin would have fallen. Yeah. So just try to look out for such reasons in your examination. Then, is there an inflationary environment? Just also try to look out if there have been some abnormal cases during the year, like some loss-making contracts or a poor dealership contract with the customer, or any sort of impairment or something like that, some rumors due to which you were not able to charge certain level of prices, or maybe government action due to which you are not able to charge high prices, something like that. Try to trace out why better prices cannot be offered into the market, or maybe vice versa. Just try to figure that out. For example, there may be a new market entrant which may be disturbing you a lot, and you are not able to charge high prices because that market entrant was basically penetrating the market. Or maybe you would be facing a fierce competition due to which you weren't able to raise your prices. Now these can be the reasons of a low gross profit margin. Otherwise, it may be a deliberate penetration strategy as well. I will connect this point while we are discussing asset turnover next. But remember, lower gross profit margins can also be a deliberate strategy to improve the overall profitability of the business. I'll tell you how that works. So it may be due to poor cost control, due to which your costs would have increased and you would have not earned a very good profit at the end of the day. Now, the other ratio that you really need to focus on is asset turnover. And it's basically going to make a lot of sense after discussing GP margin. So asset turnover has the formula, asset turnover is calculated as sales divided by capital employed. And now we already know how to calculate capital employed, total assets minus current liabilities, or equity plus debt. Sometimes it is also calculated based on total assets. So for example, if your examiner says that calculate asset turnover based on total assets, you take sales and divide them by total assets. Those are presumed to be equal to the capital employed. Yeah. So sales divided by capital employed. Whenever you calculate asset turnover, your answer is going to come like 2.3 or maybe 4.5 or maybe 5. How this ratio is basically written. So for example, if your answer comes 4, you write 4:1. This is how you write asset turnover's answer. What this basically means? This basically means on each $1 of capital employed, how much sales have been generated by the business. Yeah. So how many sales are generated on each $1 of the capital employed? This is basically asset turnover. So logically speaking, asset turnover should be, very high. Higher the better. Higher the better. If the company has contributed $100 and you are generating a sales of, for example, $500, that gives you the answer of 5:1. So that basically means on each $1 of capital, you generate a sale of $5. So the higher sales you are generating, the more are the chances that you can basically turn the business into profit. So higher the number, the better it is. But there are some, areas which you need to remember. First, asset turnover denotes the impact of volumes. So for example, in X3 and X2, if last year the asset turnover was 1.5 and this year it's 2, what it basically means is that your volume sales have increased. Remember, gross profit margin only used to tell you about prices. Likewise, Asset turnover only tells you about volume. So there is a, basically interlink of these two ratios with one another. One talks about prices, the other one talks about volumes. And you need both to basically make a profit out of your business. Yeah. So basically this ratio focuses on the fact that how efficiently we are using our assets to the benefit of business. How much sales are we generating? Remember, the higher the better, but please, the asset turnover should not be too high. For example, if you're doing an answer and your asset turnover comes up to be 8:1, you would be thinking, yo, wow, on each $1 of capital employed, we are generating $8 of sales. That's very bad. That's very good. That's very good. But that's not so good. Why? Because sometimes if your asset turnover is higher than previous years and also higher as compared to competitor or industry benchmark, that would mean that your company is basically, over trading. If your company is basically over trading or over utilizing assets, your assets will be quickly depreciated. Your assets will be quickly depreciated. And if your assets would be quickly depreciated, you won't be able to survive in the longer run, and your quality of the business would be affected. So that is over trading, or what I would say is over usage of the business. If your answer is too high, it must be close to what industry benchmark is, or maybe somewhat 10% or 20% more than what your industry average is, but not so high that you are overutilizing your assets. When you overutilize your assets, your quality gets compromised. Okay. Please remember that asset turnover always has a trade-off with margins. Yeah. So remember that GP margin has a trade-off with asset turnover. And you must be thinking, why? You see, GP margin is related to prices, and asset turnover is basically related to volumes, and both have an indirect relationship with each other. If prices go high, volumes go down. If prices go down, volumes go high. Sir, then what is the best scenario? Should we focus on prices, or should the business focus on volumes? Actually, they should focus on both. The ideal mix is that you increase your prices and sustain your volumes in such a manner that the overall return on capital employed is maximized. That's the whole idea. That's the best idea that you can have. So remember that in most likely cases, if your gross profit margin is increasing, definitely in the same question, your asset turnover would be decreasing. And you need to make a correlation while you are answering this. You need to make a correlation. You need to tell your examiner that, see, this is the correlation that I can see from basic analysis. Yeah. So what if we see a scenario in which the GP margin is also increasing and the asset turnover is also increasing? Wallah, behreen, perfect. Behreen, perfect. If your gross profit margin is also increasing, that means you are raising your prices. If your asset turnover is also increasing, that would mean you are raising your volume. That would mean that you are in a market leading position. That would be interpreted as that you are in a market leading position, and that is why you are basically earning a lot of money, also a lot of return on capital employed, even though you are charging higher prices, but then even you are able to get higher volumes. Yeah. Always remember that asset turnover may not be used in the service sector, may not be very much used in the service sector, because in the service sector, you have very less capital employed in terms of total assets and, liabilities. Remember that capital intensive industries have low asset turnover, but high margins. Why? You see, in capital intensive industries, there is high capital employed. Use simple mathematics. So if there is high capital employed because there are too many machineries, buildings and everything, as assigned into the business, or you will always have lower asset turnover, but lower asset turnover would mean that you're charging high prices. Yeah. So remember, it all depends on what nature of industry you're actually working on. Do have a look at it as well. All right. So let's move on. Now, one of the other ratios, one of the last ratios in profitability category that I want to discuss with you guys is basically net profit margin. Now, what do you mean by net profit margin? So, net profit margin is basically NPM and it's calculated as PBIT. Again, the profits before interest and tax, and you divide it by sales into 100. Now, what this ratio basically tells you is that how much operating profit is being earned as a percentage of sales. How much operating profit is basically earned as a percentage of sales. Yeah. Logically, it should be, as high as possible. As high as possible. Net profit margin upon sales means that how much net profit are you earning as a percentage of sales. So for example, if the ratio is basically 10%, this 10% means that when you did sales of X, after deducting all expenses, the cost of sales, the other expenses, the selling expenses, administrative expenses, research and development, each and everything, after you are done with each and every expenditure, you are left out with 10% of operating profitability. That is what tells you, that is what NPM actually tells you. Yeah. So while interpreting results of NPM, remember you can compare your NPM with that of your competitor. Yeah. You can compare your NPM with your past years. You can compare your NPM with industry averages. Yeah. Or with your own budgets or target agreements. So you can see that if, whether we have earned a required net profit margin, yes or no. All right. So for, some of the things that you need to take care of while you're doing this analysis. Number one, first of all, there is a trickle effect of GP margin into NP margin. So for example, if your gross profit margin is falling, most likely your NP margin would be falling as well. Right? So if you're not earning a good profit on your product, how will you be earning a good profit on your bottom line? That is, most likely not possible. So the gross profit margin affects your net profit margin. So there is a trickle down effect that you need to take care of. Then remember, you need to understand what this net profit margin or this 10% basically tells you. It tells you something about the management's administrative performance. So for example, if the net profit margin last year was 5% and it has increased to 10% this year, this is just due to the fact that management of the company or management of the business unit or management of the business or management of the division was better. Yeah. So NPM basically concludes on how did your managers perform? Did they perform good or did they perform bad? That's the whole thing that you understand through the analysis of NPM. So it's basically an assessment of management's administrative performance, nothing else, right? It validates how efficiently company is managing its indirect costs as well, like selling and admin overheads. Because till GP, you would have assessed all of the, productive costs. All of the non-productive costs are basically selling in general and R&D and, these expenses. You need to assess if these expenses are being, rightfully controlled or not. You get an analysis of it through NPM. Now again, while you are commenting on NPM, now we are going to discuss how to comment in our next slide. But while you are commenting, just make sure that you look out for accounting factors and business factors both. Now, there can be some accounting factors that basically affect your numerator and hence your net profit margin. What can be those areas? Just try to locate if there are any one-off items. One-off items highly affect your, PBIT. They might not reoccur in future years, but for at the very least for this year, they would have diluted your overall profitability. Just look out for those one-off, factors. Something like impairment. If there had been a massive impairment during this year, which was due to the economic situation of the country, for example, or of the state, for example, this would have led you to recognize a high impairment cost. But that, first of all, that was uncontrollable. Second of all, it's not going to reoccur most likely. So you need to really assess if this impairment needs to be included in the profit before interest and tax while our calculation of NPM, or should we add it back and then let our stakeholders know that if you remove this one-off effect, the profitability was much better or even worse. Yeah. Just try to focus on these one-off events. Any massive gain or loss on disposals, fair value impacts, something like that. That affect NP margin, should be excluded and then made comparison while doing questions. What I would highly suggest you to do is that whenever you find out that your net profit, for example, you have a net profit of the PBIT of 10 million, and you see that there was an impairment expense due to an earthquake that arose this year and due to which you had to lose $2 million, for example. So your $2 million would have affected your profitability adversely, but that was something uncontrollable. While you're assessing NPM is a pure management performance tool. So what you should be doing is you should be excluding this impairment. How can you exclude this? You add this impairment back, or this one-off gain or one-off loss, on disposal of a subsidiary or something like that. You should add it back and then calculate your NP margin again, and then you'll see a better ratio, for example. Just try to exclude it and then recalculate just to make a fair comparison. Yeah. Assess if there had been any reclassification of expenses that would have, somewhat affected your net profit margin maybe. Then check the business reasons for it. So always remember, whenever you are analyzing, whenever you are evaluating or you are concluding on the company's net profit margins performance, always give credit to management. If there had been good performance, give good credit to management. If there had been poor performance, you should be giving, poor credit to management. But at the end of the day, NPM is the responsibility of the management. You should give due credit to them. As simple as that. Yeah. So always remember, if there is a poor net profit margin, the management is to be held responsible for poor cost control. If there are uncontrollable factors like an inflationary environment or maybe something which led to less volumes, for example, COVID led to less volumes. So you need to identify the pros and cons, the goods and bad, and you need to give the due credit to management, and that is all. Now, you need to understand a very important, I would say, phenomenon before I move on how to comment. You see, I would rather write, how can a company basically make a profit? How can company basically make a profit? I'm talking about the basic terms. So whenever you talk about making a profit, always remember there are two key areas in generating a profit. Prices. Prices are affected by margin levels. Always remember this. Prices are affected by margin levels. How much margin you keep, affects your selling price. If you're keeping a high margin, your selling price will be high. If you're keeping low margin, your selling price would be low. And volumes. These are the two basic fundamentals of generating profitability for any business. So margins can be represented during ratios through, profit margin. Margin can be represented by NPM, which is PBIT divided by sales into 100. At the same time, volumes are important as well. You can earn a lot of money if you have high volumes. Yeah. So the other thing through which you can earn a good profit is volumes, and volumes are represented by asset turnover. The formula is sales divided by capital employed. Now, if you take the product of these two, prices and volumes, you basically get profit, right? And I can just prove it to you mathematically when you're doing ratios. So net profit margin into asset turnover can lead you to the overall profitability. You see, sales here and sales there would be cancelled, and hence you are left with PBIT from here, capital employed from here, into 100 from here. So multiply by 100. And if you look out, this formula is for ROCE. Yeah. So it's basically understood that ROCE is basically the product of two things, NPM and asset turnover. That is margins and volumes. Now, if the company has good margins and good volumes, it will certainly make out a good ROCE. And if the company does not have good margins or volumes, the company will not have a good ROCE. It's as simple as that. Yeah. But remember, both of these are often inversely proportional. How do you say so? Because when you increase your margins, most likely you are going to lose on volumes. Now, if you are able to manage both prices and volumes on a certain level that maximizes your ROCE, and ultimately the shareholders' wealth, that benchmark is something that you need to achieve. That is the most idealistic benchmark. All right. This is how you interpret all these profitability ratios. But sir, what about commenting? I need you to focus on your exam as well. So what should be the right strategy while you're commenting in an examination question? Other than the fact that you should be using words like maybe, shall be, can be, could be, what are the other factors that you should be considering? You see, whenever you start writing an answer, start with the discussion on the movement of the ratio. If you have GP margin here, in X2, you see it is 15%. Last year, last year X1, for example, it was 13%. Just start your discussion by the fact that as evident from above, GP margin has fallen by 2% this year. Just start your analysis while discussing the movement in ratio. These are very basic, strategies which I'm telling you. Start with the very basics. Start first by saying, has it increased or has it decreased? Then, whether it apparently shows a better or worse performance. Yeah, you see, if your GP margin has increased, is it a good thing or a bad thing? You see, it's very important to interpret your increase or decrease. Why? For example, if gearing was increasing, that was not a bad, that was not a good thing. If profitability is increasing, it's a good thing. Yeah. So every ratio has its own interpretation of increase or decrease. So it's very important to set it clear if it's a good performance or a bad performance. Then whenever you are commenting, just try to add back or adjust any one-off effects and then assess if the performance is better or worse. So you give a bird's eye view. Has the performance gone better or worse? And if there are any one-off events, you add those back or you adjust those and then you recalculate and then you say it in your answer that the performance had been good or bad. Yeah. So this is a strategy that I want you to follow. Then you try to find out the accounting reasons and make a sense out of ratio results. My strategy would be you talk about, you discuss whether the ratio has increased or decreased. The performance was good or bad. Then you talk about some accounting reasons. Yeah, accounting reasons we discussed in each and every ratio. Had there been any impairment or reclassification or one-off cost or something like that, a gain or loss on disposal, fair value gains or loss, whatever. You need to talk about accounting reasons first. And then you jump up and then you assess the background information given in the question and then correlate it with your results. Also, you need to comment on the business aspects as well. I'm just coming to that point. Only write those points. Remember, after accounting ratios, you need to comment on business aspects as well. After accounting areas, you need to comment on business aspects as well. And these can be industry or economy. But just only write those points which are evidenced through the examination scenario question. If there are no leases in the balance sheet, don't talk about leases. Yeah, if there is no revaluation reserve in the question, do not talk about excess depreciation due to revaluation. If the examiner did not talk about inflationary environment, do not talk about it. You just need to make up your reasons from the scenario that has been provided by your examiner. Do not provide random assessments which have no background. Don't do this, it will lose you marks. It will waste your time and you will lose marks as well, right? Discuss what further information, this is a very good strategy by the way to answer ratios questions. Discuss what further information, if had been available, could have helped you reach a better conclusion. So most of the times whenever you see a ratios question in your examination, it's not complete, it's partially complete. So there is no information regarding to market. Sometimes there is no information regarding competition. Sometimes there are no industry averages, and that gives you a mark. If you identify that I would have needed more information to come, to reach a conclusion, that will actually give you marks. So please identify during your answer that what could have more, if had been available, could have helped you better. For example, a breakup of cost of sales, a breakup of selling expenses, maybe something about competition and price levels in the market, or something like that. It will eventually help you, beef up your answer and also impress your examiner, because your examiner would think that you have a broader perspective, and that is why you are asking for more information. Always try to link one ratio's performance with the other. Always try to correlate different ratios during your answer. It will always help you. For example, lower profitability can lead to liquidity problems as the current debts become due. Now, if you are writing such a line, it will only help you, my friends. It will only help you. It will help you a lot. Believe you me. Yeah. So for each categories of ratios, always write 1 to 3 lines of conclusion. It would be better if you can write 1 to 3 lines of conclusion by the end of each category. Yeah. So how do you write conclusion? Just write overall. It can be concluded. For example, it can be concluded that poor economic conditions led to a decline in profitability. However, future years can be improved. Whatever the reason may be, just write a 1 or 2 line or 3 line conclusion, and that would always impress your examiner. So please keep these points in your mind while you are making up your answer for any question that relates to ratios. These points are not just for profitability ratios, but are common for any of the ratios that we talk about. Yes, I have talked about these points in the starting, but these can also be applied for each and every category of ratios that we are going to discuss right now. All right, so now let's start with liquidity ratios. First of all, we need to understand what are liquidity ratios. So liquidity basically means the company's ability to pay off its short-term debts on time. You see, when the business is running as a going concern, it normally operates as, buying raw materials on credit, buying different short-term supplies on credit. And when you buy something on credit on a short-term basis, you need to be able to pay it on time. If you don't pay it on time, your future supplies can be affected, or your supplier may take you to the courts, exposing you to creditors' voluntary winding up, right? So liquidity is important, and primarily, short-term lenders tend to see your liquidity ratios, assessing if you are in the short run, if you are viable or not. All right. So one of the first ratios that we are going to discuss here is current ratio. So the formula for current ratio is that you take on your current assets in the numerator, and within the denominator, you take current liabilities. So within the denominator, you take current liabilities. And whenever you get an answer from current ratio, it is normally as, for example, if you had, $10 of current assets against $5 of current liabilities, your answer would come as 2. And you would denote this answer as 2:1. So basically what this denomination actually means is that for each $1 of current liability, how much current assets do you have? So current ratio basically tells you that how much current assets are available to settle each $1 of current liability. So normally it goes without saying. From the perspective of your short-term lenders, the higher number of current ratio that you have, the more likely they are going to be impressed with. So the more likely they are going to be impressed with. So they feel safe when you have more current assets backed up in and you can pay off your liabilities easily. Now, remember that current ratio only denotes the short-term liquidity of the business. It does not talk about the long-term viability of the business. It can be possible that the company is liquid in the short term because it has taken, too much loans. So a fresh loan note can beef up your cash levels. You see, what comes into your current assets, primarily think about it. Three type of assets are primarily, they primarily become part of your current assets, primarily. So on a working capital basis, you have inventory in your current assets. You might have got receivables in your assets. Yeah, most likely. And then you have cash. Now it's easier to improve your liquidity position, your short-term liquidity position, just by taking up a loan. For example, you can see in the financial statements while you are solving a question that the company has taken a fresh loan note, towards the end of the year. Now what that would do is it will beef up your cash. And hence it will, your current assets would be more than your current liability, showing off a good liquidity performance. But again, you need to figure this out in your mind that this current ratio only depicts the short-run impact. It can be a good possibility that if the company cannot utilize this money in a good manner, all of this money will go into drain, there will be losses, and then ultimately in the near future, you won't be able to pay off your debts. That will bring you down. So even though current ratio might be well, that does not mean that the company is necessarily going to survive in the longer run. You need to have that understanding in your mind. Yes, essentially, I do agree that higher the current ratio, the better it is. So for example, if you have a current ratio of, 10:1, you would say that certainly we are in a very good position in the short run. Only $1 of current liability, and for each $1 of liability, we have $10 of current assets within us. So we are a safe company. But on the other side, I would say that, 10:1 current ratio may be somewhat risky for the business. Why? Because always remember, there is an inverse relationship of liquidity with profitability. The more liquid the company is, less likely it will be much profitable. Why? Because remember, a company cannot earn, very good profits if it is keeping its money in current assets. I mean, where are you keeping your money? If you're keeping your money in inventory, you're actually not selling it. If you're not selling it, you're not earning a profit. So it's a downside actually. If you are having good money in your receivables, okay, you might have good, somewhat good profitability. But if you're not recovering cash from your customers, ultimately one day or the other, you are going to lose. And again, if you have too much of cash with you, if you have a current ratio of 10:1, that would certainly mean you have a lot of cash with you. But if you are just piling up cash within yourselves and you're keeping good current assets, then you cannot earn a profit. Why? Because you need to invest money into non-current assets, into property, plant and equipment in order to earn a return. So keeping a lot of money in cash does not mean that the company is performing well, because most likely it would be losing in terms of profitability by not investing in real non-current assets, right? Now, always remember that current ratio's answer may somewhat increase or decrease over the years. There can be a possibility that your current ratio is higher or lower than the other company that you're comparing with. And also, it's a good possibility that your current ratio does not match the industry average. Either it is higher than the industry average or it is lower than the industry average. Now, in an exam, you need to come up with reasons that justify the movement of your current ratio over the period or against your company or industry. So you need to work on it. Now, I'm going to identify some of the potential reasons that might affect your current ratio, and you need to trace out such examples in your exam. So for example, you need to find out some accounting factors. Now, accounting factors are not real business reasons, but these are reasons that eventually affect the answer of your ratio. So for example, here the inventory, the current ratio can be highly, easily manipulated by keeping high inventory levels. So later on, we'll be studying something which is known as inventory days. Now, inventory days tells us that how fast we are able to sell our inventory. Now, if you see in a question that your current ratio is on a higher trend, but your inventory days are also increasing, that would give you a clear indication that current ratio is not depicting the true picture. Our inventory days are increasing, and that would mean that we are not able to convert very good sales, which is a business risk in itself. So you need to figure out these point of things. You need to look at the absolute amount of inventory levels that are given in the balance sheet of your exam and see if the inventory levels are too high and due to which your current assets are increasing. Yeah. I've seen some questions in the FR exam in particular that your examiner does not provide you the detailed breakup of current assets. You see, there are extract of balance sheets given in an exam, and you see that in the balance sheet only the current assets one line item is given and the clubbed amount of current assets is presented in front of you. And here you have an option to tell your examiner that had I been given more information, it would have been much easier to analyze the impacts of current ratio or the reasons behind the massive increase or decrease in current ratio. So always look out for those small marks that are given in the exam. Yeah. So breakup of elements are essential to reach a meaningful conclusion. Always demand those breakups if they are not available. If they are available, just make a reason out of them. Yep. Are your inventories increasing? Are your receivables increasing? Or is the cash too high? Then you need to look at some business reasons in the question. Always do not create business reasons on your own. Always try to read your exam question very clearly, very slowly, and that will only help you to come up with logical business solutions or logical business rationale behind the movement of current ratios. Yeah. So just check out how the profitability is going. If the company has been making a loss since past 3-4 years, that would have eventually affected their current ratio. So if you are not earning a profit, your expenses somewhat equal your incomes, and therefore you don't have residual cash. And if you don't have residual cash, your cash balances will start to decline, and ultimately you will be seeing a lower current ratio. So just make use of your brain just to virtually analyze what would happen if a company is not going profitable. It won't have cash for sure. Then look out, is there a major investment just before the year end? So often there comes a scenario in your examination questions that you would have recently acquired another subsidiary. So if you have acquired a subsidiary and you paid them in terms of cash, for sure your cash balances would have gone down, which would have highly affected your current ratio. But see, it's a strategic decision. Your current ratio would have gone poor during the current year, but since you have acquired a profitable subsidiary company, it might help you recover that cash levels in future, because that subsidiary is going to provide you some synergies and also going to provide you some profit levels that will help you beef up your cash once again. So look out for just, these kind of business reasons. Then you need to assess that how much portion of current liabilities is an overdraft. Always see that. If you see that high level of current liabilities is basically overdraft, then you just imagine some part of your current liabilities would also be present in your current assets. So there might be a balancing effect in your numerator and denominator. Whatever overdraft you take, you might have got an overdraft, the money that you got through an overdraft in your current assets as well. So somewhat a diluting effect would have come. The other thing that you need to consider while you're looking at an overdraft is your overdraft is immediately repayable on demand. On your payables, you must have got some credit, 30 days, 60 days, 90 days, you can pay it later. But overdraft essentially is a demand. It is a tool through which a bank can immediately ask you to repay that overdraft. So for example, if 70% of your current liabilities consist of an overdraft, that would mean that you're at high risk. Even though your current ratio might be okay, just because of the fact that some of the money is still in the current assets or in inventory or in receivables, But seriously, if your current liability consists majority of an overdraft, that would have got a risk on you that you might, you might face a short-term liquidity risk every now and then if you're not able to meet up the requirements of your bank. It may force you to pay anything and everything that you owe to them, on demand. So it's a risk. You see, current ratio is a very good ratio in order to assess risks, in order to assess short-term liquidity, in order to assess business position. Current ratio is an absolute wonderful ratio, all agreed. But you see, current ratio has a very big disadvantage. It is not applicable on such companies, which have slow moving inventory. It is not applicable on those companies which have slow moving inventory. So for example, there is a housing society, there is a housing construction company. Now their current assets would have largely got, some partially built or half built or fully built houses with them. Now those are inventory and those are of high value. So you would have some high current assets, but they cannot be sold in the short term to pay off your current liabilities. So they do not the numerator and denominator do not correlate with each other. You should remember that current ratio, used to show that how much current assets do you have in order to pay off your current liabilities. But having slow moving inventory in your books does not mean that you will be able to sell them in the short term and pay off your current liabilities. So technically, for businesses that have slow moving inventories, just like some car businesses, cars cannot be sold very quickly, housing agencies and so on and so forth. So you cannot sell your assets very quickly. So that does not help in really assessing the liquidity risk that is upon the company. All right. So for that matter, since slow moving inventory businesses cannot apply current ratio and reach a meaningful conclusion, for such type of companies, we have developed another ratio, and that is known as acid test ratio. Acid test ratio. So it's a harsh measure towards liquidity. It is also known as quick ratio, by the way. So sometimes you might read in any study text or book or any exam that there is something mentioned as quick ratio. Quick ratio or acid test ratio is one and the same thing. So remember that, acid test ratio is basically a very strict measure towards liquidity. And you must be asking, sir, why is that? How is that? You see, the formula of acid test ratio is that you take on your current assets, you subtract your inventory from it. All right. So there was a risk in companies which have slow moving inventories, that since your inventories are kept for a longer period of time, you won't be able to sell these in the short term and pay off your current liabilities. So the ratio in itself was meaningless for some companies. And that is why in acid test ratio, what we do is we exclude the inventory from our current assets, and purely liquid assets such as receivables and cash balances are taken in current assets, and then we divide it by current liabilities. Yeah. So we take highly liquid assets in the numerator. All right. So this is a harsh measure. Acid test ratio can be highly important during crisis moments. Just imagine. You see, by the way, I will make up my case, in order to explain this point. Acid test ratio should be applied on those companies which have slow moving inventories, but you cannot apply this ratio. Principally, you should not be applying this ratio on, for example, those companies which are FMCG, or maybe, supermarkets, for example. You should not be applying this ratio on supermarkets. Why? Because, supermarkets or FMCG, fast moving consumer good companies, these are type of companies who always, invest most of their money in their inventories. Just imagine a supermarket. Just think about Target. Does Target or Walmart maintain a lot of cash with themselves? The answer is no. Whatever money they have, they try to buy stock from that so they can, purchase at a good price based on economies of scale, and then when they sell at a higher price, they make a profit out of it. So if someone was to apply asset test ratio on Walmart, most likely this will be a highly 0.00 something number, because you see, a lot of money they have already in their inventory. They have invested in inventory. And if you exclude that, they don't have receivables. A supermarket does not have receivables. They might be maintaining very low levels of cash. So obviously the quick ratio would show a very bleak picture. But that's not the point. A fast-moving consumer goods company always invests in inventory, and it's a fast-moving consumer good company. It's not a slow-moving company, so that it does not have that kind of risk. But you see, when COVID came, at the times of COVID, the asset test ratio even became relevant for such type of companies. Sir, why? Asset test ratio became relevant for even FMCG. Because when a crisis came, when COVID came, everyone was in lockdown. Since everyone was in lockdown, sales were not happening. And since sales were not happening, these fast-moving consumer good companies or the supermarkets, much of their items are basically, perishable items. So you cannot just rely on inventory levels and say that you're very good in the short run. Okay, the sales are not happening, you have high inventory, your current ratio would be fantastic. But that would be meaningless for the lenders, because you are not able to sell your inventory due to lockdowns or due to any crisis moment, wars or anything. And thereon, if you need the real picture of liquidity, you need to calculate the asset test ratio for even an FMCG in order to assess what is the risk. Can they pay off their current liabilities, yes or no? And essentially, if ever you get an answer less than 1, for example, 0.5:1, this is a risk for your lenders. Because in order to pay each $1 of liability, you only have $0.5 of assets, and that would be concerning for your lenders, your short-term lenders, your suppliers. Yeah. Remember, if there is too much gap between current ratio and quick ratio, that would denote high inventory levels. So sometimes in your exams, what comes is that your examiner does not say anything. It provides you a current ratio of, for example, 5:1. And then there is your quick ratio, and that is like, 1:1. And here it is easily understood. You do not need any further information. The answers are already given. You can see that the difference between current ratio and quick ratio is massive. And that would certainly mean that the current ratio was highly inflated due to inventory. And this poses a risk on the lenders, on the company, on the investors, that the company is not able to sell their inventory. They are keeping high inventory levels. Yeah. So it's a risk. This is how you need to identify in your exam. Not every time you are able to calculate a ratio. Sometimes your examiner will give you a pre-calculated answer and you need to interpret that. So if there is a lot of difference between your current ratio and quick ratio, just think about it. That's the inventory that is the troubling area. Yeah. Some discussion points for you. Quick ratio is suitable for businesses that have risk of slow moving inventory. For example, fashion companies. For fashion companies, you should, in order to assess the liquidity, you should be checking out their quick ratio, not their current ratio. But for fashion companies, they might have got some out of date unsold stock, and that would have beefed up their inventory, and ultimately, that would have beefed up their current assets. They would be showing good current ratio. Then you calculate quick ratio to assess if they are really good, if they are really, based on strict measure, they are able to pay off their current liabilities, yes or no. So technology companies, for example, it is certainly not suitable for retailers or FMCG. That's the point that I already made. Yeah. So this is everything for liquidity ratios. So now let's move on to gearing ratios. Now gearing ratios is one of the third categories that we are going to study in the ratios overall series, right? So first of all, you need to understand that what do you mean by gearing? Now, gearing basically represents the amount of debt that you have in your overall capital structure. I'll repeat it again. The amount of debt that you have in your total capital structure. And you'll get to understand this a bit better when I tell you the formula of our first ratio, which is known as financial gearing. Financial gearing. Now the formula for financial gearing is that you take on debt on the numerator and divide it by debt plus equity multiplied by 100. So remember that your overall capital structure that a business would have would comprise of, debt and equity. We have all read about the accounting equation in our, earlier basic class studies. Accounting equation is capital plus liabilities. Assets are equal to capital plus liabilities. So whatever assets that in a business that you have, they are always funded by either the shareholders' money or the debt holders' money. Yeah. Now the debt holders' money has to be paid back. So in your overall capital structure, which is represented by this, circle, how much debt you have, this is represented by this ratio. So for example, if the answer comes as 40%, this would mean that in your 100% capital structure, which is obviously financed by equity and debt both, in your 100% capital structure, you have 40% debt. Now, if this answer comes as, for example, let's say if this answer comes as 60%, now that 60% would mean out of the total capital structure that we have, the 60% is debt, and that would mean 40% is equity. Now, I would like to highlight this, before I move on, I would like to highlight this, that sometimes your examiner does try and calculate gearing through this formula, which is debt divided by equity. The whole point of view is that both of the formulas actually represent the same thing. Now, if debt divided by equity, the answer is higher. If you have higher debt than equity, then obviously you have higher gearing. You have higher debt than equity. That means that you have higher gearing, higher debt as compared to equity. So sometimes your examiner follows this formula and sometimes your examiner follows this formula. Sir, which one do we follow in our exam? Now remember guys that this is the standard formula that you need to follow. If ever your examiner would want you to follow this formula, which basically represents the same thing, that anything beyond 100% means high gearing, yeah. Anything which is less than 100% means low gearing. Yeah, if debts are higher than your equity, your answer would be greater than 100%. If your equity is higher than your debts, your answer will be less than 100%. So if your examiner would want you to follow this formula, that will be said in your exam. That will be specifically told you in your exam. Otherwise, you follow this formula. This is the standard formula. Yep. So as said, the financial gearing, it basically measures the relationship between your debt and your capital structure. Now, here is a catch from an examination point of view. You see, debt means your non-current liabilities. Yeah, debt means your non-current liabilities. Now, if you ask me technically, while you are calculating financial gearing, your debt number should only include those liabilities which are interest-bearing liabilities. Sir, what are you trying to tell? You see, for example, when you look at a balance sheet, your non-current liability might consist of a loan. It might consist of some finance lease. At the same time, it might also contain some deferred tax. Now, loans and finance leases expose you to financial risk. What is financial risk? I'm just going to tell you, but for a brief overview, anything which on which you have to pay interest on a fixed basis is basically, that is basically known as financial risk. You do not need to pay any interest on your deferred taxes. You do not need to pay anything on your deferred taxes. So it's basically not an interest-bearing liability. Now, conceptually speaking, whenever you are calculating gearing, you should only include those liabilities in your formula which are other than deferred taxation or so, which are not interest-bearing liabilities. They should be excluded. But here, I tell you how to earn some marks. What you should be doing is, that first you should calculate gearing based on whatever non-current liabilities your examiner has provided you ready-made. Then if there is any deferred tax given, then you readjust the formula by following a second step and then tell your examiner in comments that if we exclude the deferred tax liability, which is not an interest bearing liability, our answer should be this, and this represents XYZ. It should be interpreted like this. Yeah. So it will give you 2 marks. First of all, you calculated the ratio as per the formula and then told your examiner that this formula should be interpreted without deferred taxation, and that would give you the real picture. Your examiner will be impressed and you will have the opportunity to gain good marks. All right, gain good marks. This is a strategy I wanted to tell you. Yeah. So deferred tax, for example, is not an interest bearing liability. Conceptually speaking, you should not be including that in your gearing calculation. Now, why is any company concerned with the level of debt that they have in their capital structure? Why is it a concern in the first place? I mean, companies do raise finance from various sources, sometimes equity finance and sometimes debt finance. What's wrong with debt finance? You see, what's wrong with debt finance is basically it creates a financial risk on the company. Sir, how would you explain that if a company has more debt, it creates a financial risk on the company? How do you explain that? I'll explain that to you through an example. So let's say there are 2 companies, A and B. Yeah. And they both have an operating profit of $50. So they both have an operating profit of $50. And then you are given their capital structure. Yeah. So for the first A company, they have a $100 debt, which has an interest rate of 9%. And then they have equity of 900. So if we were to calculate the gearing ratio of A, it would be 100 divided by 900 plus 100, which is 10%. Yeah. So for A company, the gearing is 10%. Understood? And then there is some B company. They have the same operating profit as we do. So basically both of the companies operate on a same level, on a similar level. They both earn same amount of profits, but their capital structure is a bit different. They have debts of 400 and equity of 600. If you were to calculate their gearing and you apply the formula, and then you will know that they have a gearing of 40%. So 2 companies are there in front of you. Both companies earn the same amount of profit before interest and tax. They both are same on, based on operational levels right now, but one has less gearing and the other one has more gearing. All right. Now, your examiner says that, your tax rate is 20%. Your first case is you should be calculating profit after tax for shareholders in this case. Now, I'm just illustrating what will happen. Just follow me as I go through. We will just calculate PAT. We will just calculate, profit after taxes in the first case. So there is A company and then there is B company. So both companies have a profit before interest and tax of 50 and 50. So then we need to account for interest. And if we look at interest, so A company has only got $100, loan on which they have to pay an interest of 9%. So 100 into 9 is basically 9. 100 into 9% is basically 9. And if you talk about the other company, they have a $400 million loan or a 400 loan, and they also have an interest rate of 9%. Just for the sake of comparability, we have kept the same interest. They have got an interest of 36. Yeah. So here comes the profit before tax, and that is supposed to be 41 for company A. And for example, the normal profit that comes with company B is 40. Yeah. And then there is tax of 20%. So 41 into 20% would mean that 8.2 is the tax for A company. And when you talk about, for example, B company, the tax would equate to 2.8. So what is the profit after tax, my friends? 2.8 minus 14, that would lead you to 11.2 of profit after tax. And for the A company, 41 minus 8.2, that would be 32.8. So up till now, some things are pretty apparent. First of all, you can see that the operating profit levels for both of the companies are same. All right, it makes sense. One has higher debt, and therefore they have higher interest. They have low profit before tax and therefore low profit after tax. That is well understood. That is well understood. No problems at all. Now, we have done the part 1, and in order to do part 2, I would like to copy paste my this, profit after tax, which we calculated here. And I would take this here. I'll just save it. Case 1. And then I'll tell you what am I actually trying to prove. How does debt create financial risk? I'm just trying to prove that. Let us just rub a bit and see what your examiner says in part number 2. It says that, you see, recalculate everything. If what would happen if the PBIT falls by 20%? What would happen if your profitability falls by 20%? So if my profitability falls by 20%, my PBIT would fall to 40. You can easily calculate 50 into 0.8. It would be 40. Yeah. So my profitability is basically down 20%. Understood? Yeah. Then what would happen? Then you have an interest payment to make. So for the first case, you have an interest of 9. I remember that from before. The other case, you have an interest of 36. Okay. And then you get PBT, profit before tax. And here you have it, a profit before tax of 31. Obviously lower than before. Since you have lower operating profits, the profit before tax is also less. Here is 4. Then you get tax at 20, and 31 into 20 would lead to 6.2, and 4 into 20% would lead to 0.8, and that would mean 3.2 in case number B, and in case number A, that would lead you to 24.8. Sir, we don't actually get the point. We don't get the point. Here you can easily see that B company has less profit as compared to company A. But sir, that was the same case. That was the same case in case number 1. What are you actually trying to prove? Now just follow me what I'm saying. I want you to calculate percentage difference in PAT. Percentage difference in PAT. And how would you calculate it? You have an earlier figure of 32.8. You have an earlier figure of 32.8. And now your profitability falls on to 24.8. The difference, what is the difference between these two? So 32.8 minus 24.8 is 8. Divide by 32.8. If you calculate the percentage difference, that would equate to 24%. That would equate to 24%. And if we do the same for example, company B. So here 11.2 minus 3.2, you get 8 again. And when you divide it by 11.2, you get an answer, a skyrocketing answer of 71. So what are you trying to prove? It's basic common sense. It's proven that debt is a very good source of external finance because you get money from external investors which are not your shareholders. So they give you money and without even getting the voting rights. But debt creates a financial risk upon you, because when times go bad, the company which has higher level of gearing will be highly impacted by the fixed interest that the company would have to pay on their loans. You see, in this case, it's apparent. Our operating profits went down by 20%. A company's profitability was affected only by 24%, while B company's profitability was affected by 71%. The company with higher gearing levels, is always affected more in bad times as compared to the company which has low gearing levels. Now, this impact or this scenario is known as financial risk. Financial risk is the risk that if something goes bad, you will still have to pay your interest, and you will get a larger dent on your profit after taxes in case you have high gearing levels. So high gearing levels always lead to a high risk. Likewise, if the profitability would have improved by 20%, the situation would have been different. The interest payments would have stayed constant and the profitability would have improved massively. So debt payments, debts basically brings you both sides. Greater the risk, greater the return. In bad times, debt can be lethal. It can wipe out your profitability. It can wipe out your business just like that. And in good times, it can earn you a lot of money. It can earn your shareholders a lot of money, but still it is risky. Debt creates risk. You don't know what's the outcome. Yeah. So that was the point that I was trying to make through this illustration. Now, while you are doing an examination question, always look out if your gearing is largely increasing or decreasing over the period. Just see if the company's debt ratio is rising. In order to assess if the financial risk is somewhat sustainable or not, you should compare it with your industry average. If it's higher than industry average, then this company is taking a lot of loans. And it also beats the industry. That means that the company is going in crisis. Either its profitability is not working out, or they are just, out of money, and that is why they are raising loan notes. Yeah. And that whenever you raise loans in haste, it actually costs you more. Interest rate gets high. So bear in mind that concept as well. The other reason why your debt ratio could have been increasing is maybe due to falling equity. You need to bear this in mind, the formula of ratios. Yeah. The formula here is that you have in denominator equity. So for example, if the company is facing continuous operating losses, it has retained losses, your equity would go down. Or maybe due to devaluation, your equity would go down, and that would result in financial gearing. You need to, identify such areas in your examination question that if your equity is going down, automatically your gearing levels would increase. That does not mean that the company's debt is basically risky. Just because of the fall in equity, your gearing has increased. Overall, the debt levels may be same in absolute levels. Yeah, in absolute terms. So look out for if there is a equity decline, and then you need to actually see if your gearing ratio is increasing. You need to figure out in the question that why your gearing is increasing. I mean, if your gearing increases just because you have acquired a particular company, a subsidiary, a profitable subsidiary, I would support that gearing level, because today's gearing, today's risk would give you a greater return in future. Yeah. So it should make sense why the gearing is increasing. But if you're not acquiring any other company, you are not profitable, but still raising debt, that would be very risky for me, because, you're taking long-term loans and you don't have profit, you're not acquiring anyone. So that means you are covering up your losses in terms of cash. Yeah. So all the loss that you make in your P&L and all the loss and the shortage of cash that you have due to these losses, you're trying to cover up that with new fresh loans, and that would be very risky for the company and the investors and the lenders as well. Just look out if there has been any revaluation. If due to revaluation your equity will increase and your financial gearing will decrease, that would not mean your risk has decreased, but it would just be an accounting reason for a decrease in financial gearing. Yeah. Lease liability, check out for that as well. Now, there are two ratios that you need to study in the gearing category. One is financial gearing, and the other one is basically interest cover. To me, actually, interest cover is more important than financial gearing itself. To me, I feel it that way. You see, let us say that there are two companies, company A and B. Company A has a gearing ratio of 40%, whereas company B has a gearing ratio of 5%. Or, maybe I'll make it a reasonable number of 10%. Yeah. So just by looking at the numbers, gearing numbers of, these two firms, you would say that B company has less gearing and therefore it is a better company. It is a less riskier company as compared to company A. And that is what you would say. Actually, that's not true. I mean, for any time that in a question that you get a gearing ratio, ideally you should always be calculating interest cover. Even if it is not part of your requirement, if I were a student, I would always calculate interest cover. You know how interest cover is actually calculated? The formula for interest cover is you take your PBIT and divide it by your interest. So for example, if your PBIT is 10,000 and your interest is 2,000, the answer would come as 5 and you write it as 5 times. So what does this basically mean? This basically means is that the level of profit the company earns, it can pay the same interest 5 times and then it would break even. Basically, the higher interest cover that you have, the more safer you are. There is no harm in taking debts. There is no harm in taking debt. Not every debt is bad. As long as you are profitable enough, to pay off your interest payments, as long as you have that kind of space, everything is fine. Everything is fine. So basically, you would say that higher the ratio, higher is the margin of safety. So higher the ratio is, for example, if this answer comes to be 20 times, that would be much safer for the lenders because the company earns so much profit that it can pay same level of interest 20 times. It's a safer company. Yeah. So, ideal ratio varies from industry to industry. If the ratio is too low, then the debt is certainly not sustainable. I'll come back to my original example. Yeah. So basically, I would rather, explain it here. So basically, there were two companies. There was one company, A company, with a gearing ratio of 40%, and the other company was 10%. At once, you thought that A company is more risky company, and it has bad performance. It's not managing its, debt levels very carefully. But what if I told you that interest cover, the ability of the company to say same interest, how many times, interest cover for A company is 10 times, whereas for B company, it is 0.5 times, less than 1. Now, you tell me which company is in trouble. You should certainly say B company. You see, it's not the percentage that actually matters. A company with 100% of gearing but 100 times of interest cover would make sense. Obviously, there cannot be a company with 100% interest gearing. There must be some equity. But still, I'm just trying to improvise and, teach you something. Even if a company has 80% gearing, but it has a high interest cover, it's a safe company. If a company has 5% gearing, but 0 times interest cover, it's a very risky company because it does not have the profit to pay off its interest. Yeah. So always combine interest cover analysis with your gearing analysis in order to reach a conclusion. Yeah. Always see if there is a short-term impact affecting this ratio. Are there any new loans or liabilities? Gearing ratio deteriorated due to acquisition of a subsidiary. All basic areas. Yeah. So you can read it on your own. But please try to understand that interest cover is, one of the most essential parts when you are assessing gearing ratios. You should not be assessing gearing ratio on its own. Combine interest cover with it and then it would make more sense. All right. So now continuing from where we left off. Now, the category of ratios that we are going to study is basically working capital ratios. Now, working capital ratios are important for FR students, but they are slightly more important for FM students. In FM, you've got a whole section about working capital management, and therefore you need to study these type of ratios pretty clearly. Now, these are one of the most important, interesting ratios that you can think of. Now, when you talk about working capital ratios, first you need to understand that what is working capital actually. So, working capital in accounting is basically known as the difference between your current assets and your current liabilities, right? So, what do you actually mean by this? So, working capital is basically the net investment that you have put in your short term operations. This is the investment in your short term operations. Now, you need to note that a business cannot run wholly just by non current assets. You'll have plant and machinery, you'll have some building, you have some office building, you have some sales, sales office or something, but you cannot only run based on a property. You need to in a business trade, you need to have some inventory within you. Obviously, if the market requires, you'll be providing some credit sales, so that comes with receivables. And then again, you should be purchasing on credit because everyone else is doing so you have some payables. Netting these off, the receivables, the inventory and the payables, netting this off, this is the net investment that you put in your short-term operations, day-to-day operations, and you need to manage them pretty clearly. So in current assets in particular, when we talk about working capital ratios, in current assets in particular, there is inventory and there are some receivables. In current liabilities, for example, you have some payables. So inventory, receivables and payables are the three most important things considered in working capital. I do agree that in current assets, you not only have working capital you not only have inventory or receivables, you have cash, you have some prepayments and so on and so forth, all agreed. In current liabilities, you only don't have payables, but you also have some accrued liabilities and you also have some, taxation liabilities, provisions and so on and so forth. But from a management point of view, from a controlling point of view, inventory, receivables, and payables are some of the things that you can actually manage. Besides them, prepayments are generally a smaller proportion of your current assets. Your accrued liabilities and your taxation liabilities or your provisions are somewhat really uncontrollable. You cannot actually manage those. So from an analysis point of view, those are not as important as they seem. So, although they are part of your current assets and current liabilities and therefore your working capital, we primarily, try to assess these three key things because they are material. And if these three are managed, everything will be managed by themselves. Now, the assessment of whether inventory, receivables or payables, where to look at and how to look at them, we'll be, studying this inventory, receivables and payables key elements of your working capital, bit by bit through individual ratios. So for example, when you talk about inventory, there is a particular ratio that accountants and practitioners usually use, and that is known as inventory days. Now, what is actually inventory days? So inventory days is basically a ratio which tells you that on average, how much time does it take to convert inventory into cash? You see, in order to run a business successfully, you need cash, you need liquid cash. And that you can only have when you have, you have successful conversion of your inventory into sales, and thereby you are then able to collect the cash against that good. Yeah. So inventory days basically tells you that for how much period on average you are holding on to your inventory, or in other words, how much time you take in order to convert that inventory into sales. So for example, if the answer of inventory days comes as like 30 days, so this 30 days would mean that on average you are holding on to your inventory, a business is holding on to their inventory for 30 days. Or you can say that it takes 30 days for a company to convert their finished goods inventory into sales. Ideally, inventory days should be as low as possible. It should be as low as possible. Ideally, that should be zero. Whenever a business holds on to its inventory, the longer it takes to convert their inventory into sales, the more holding cost you have to incur. And that is literally not good for the business, and it's not good for the liquidity as well, because all of your money is technically stuck in your inventory. Yeah, so all of the money that you have put in the business, that goes into your inventory, and the longer you take to sell those, the longer you'll have to finance yourself, the longer it will take to have cash in your hands. So ideally inventory days should be zero. The companies that actually follow zero inventory days are the companies that follow the JIT technique. JIT technique means just in time. You must have heard about it in your earlier studies, or maybe in a management accounting paper, and that's a reality. Just in time is an approach through which a company aims to keep zero inventory levels. So they only order inventory when they have an order from their customer. So at the back end, they only orders supplies from their suppliers. Whenever they get an order, they quickly take those supplies, manufacture it, add some value on it, and then they sell it to the seller. So it's a minimum period of time that you're actually holding on to a particular inventory. So just in time is a very good approach to have zero holding cost. But in some of the businesses, that is technically not possible. I mean, just consider if it's a supermarket business, it's Walmart or Target or any business like that. You cannot just keep zero inventory. You see, just think about it. How would you feel if you go into a Target store, or if you go in a Walmart store and you see that there is a particular item that you really wanted and then it's not there? You go to the counter, you ask them, where is the item that I really wanted? It is supposed to be there. And they say, okay, you want it? We'll just order it from the factory, and so that you can have it. So it's going to be troublesome for Walmart to not keep any inventory. But maybe it can work out from for some technology businesses like HP. So HP does not need to hold on to any inventory. What they can do is they can collect orders from some of their clients or agent or distributors, and when they have an order in their hand, they can actually start their supplies rolling on. Then they can ensure that they have the lowest inventory period. Yeah. So in business, you need to hold on to some inventory. So ideally it should be zero, but practically having inventory days zero would not be possible. However, they should be as low as possible. Yeah. So remember, lower the better. And what if you see a longer inventory days ratio? Longer ratio would reflect that there is risk of obsolescence or a slowdown in sales. Remember, if you see if there is a company, in X2, you see their inventory days is 50, and in X1, it used to be 30. And then you compare it with the industry average, and thereon you also see 35 days, average 35 days of inventory days. So you would certainly feel that, last year we had inventory days, the time that we used to hold on to our inventory was 30, and it was somewhat near to the industry averages. Now, if inventory days increasing, that would mean that there is a slowdown in sales. And whenever you have a slowdown in sales and you're piling up on your inventory, there is always a risk of obsolescence or risk of some damage or something, right? So it's not good if you see inventory days increasing. And plus, just think about it from a finance point of view. If you have high inventory levels, if you have high inventory days, the consequence of it would be that you would have to put in more money. Your money would be all stuck in your inventory, and then you would need to arrange more money in order to finance your other operations, like just paying off your wages and rentals and everything like that. So if inventory days is increasing, it's a bad trend. It's a bad trend. It's not a good thing to have higher inventory days. And then when you're done with inventory days, the next ratio that I really want to talk to you guys about is basically receivable days. Yeah. So what do you mean by receivable days? Like inventory days, receivable days tells you a similar thing for receivables. For example, if you get an answer of 30 days on receivables, so this 30 days basically reflects the fact that on average, it takes 30 days, by the company to collect cash from their credit customers. Yeah. So on average, how much time does a company take to recover from its receivables is known as receivable days, Like inventory, it should be, lower it is, the better it is. The quicker you arrange money from your receivables, the safer you are. For example, if your receivable days are increasing, so that means it takes a longer period of time to recover cash from your credit customers. And whenever there is a longer period of time in which you are unable to, recover your cash, there is always a risk of bad debt. So you can lose out money from that customer. So the earlier it is, the better it is. So can we actually go on to have zero credit sales and therefore zero receivable days? Is that really possible? I mean, it is possible, but you see, you also need to follow the industry trends. So for example, if your competitor is giving 30 days of credit to a customer, you cannot just say that I'm going to have zero receivable days, because then you'll be losing onto your sales, because every one of your customer would go onto your competitor and take the benefit of 30 days, take the benefit of 30 days credit. So in practice, what companies need to do is they need to abide by the industry averages. Yeah. So everyone, gives credit, but as an accountant, you need to make sure that your receivable days do not increase beyond a certain level, because after that, your receivables have more chances of going bad. The later you try to recover, the harder it is. Yeah. So it should reflect industry practices. The longer ratio will eventually affect liquidity. Remember, if you are unable to recover cash from your customers on time, you will have to put in more finance. You'll have to put in more finance in order to, finance your other expenditures, your rent, your salary, your eating and lighting and others. And for that, you will be incurring higher finance costs. So a higher receivable days actually affects your P&L. A higher receivable days actually affects your P&L. So basically, there is a cross reference between what working capital management tells you, and then there is a cross link with liquidity ratios, and then there is a cross link with profitability. So if you have higher receivable days, most likely you will have poor liquidity, because all of your money would be stuck in your inventory or receivables. Yeah. And if you have poor liquidity, it might affect your profitability as well, because your inventory might go bad, your receivables might go bad, and eventually they will hit your profitability. So an accountant needs to make sure that he reports on inventory days and receivable days in a regular manner, so that it does not affect your liquidity and profitability in the near future, in the medium term run. So the next type of ratio that we have is basically payable days. Now, what do you mean by payable days? Payable days actually mean how much time do you take how much on average time you take to pay off your suppliers. You see, payables means a part of current liability. Now, current liability are opposites of current assets. So the strategy must be opposite as well. In inventory and receivables days, I told you the lower the answer, the better it is, the better the company is performing. But in payable days, the higher payable days you have, technically the better it is. So we always say in finance, if you want to receive money from someone, make sure that you receive money from them as soon as possible. But if you need to pay anyone, you should be paying as late as possible. I mean, that's the fun part of it. On one side, you literally tell your customer, pay me as soon as possible. But on the other side, you'd like to talk to your supplier that I'll be paying a bit later. Yeah. So higher the better ratio it is. Yeah. But if someone was to ask that, how later should I pay my supplier? How at least give me some benchmark, how late I should pay my supplier. Now, one answer is that you should pay your supplier as late as is practically possible. Do not pay your supplier too late so that he becomes disgruntled. He builds up on grievances, and then he says, okay, I'm not going to supply you anymore. Don't do that. But at least your payable days should be higher than the sum of your inventory days and receivable days. So what do you mean? I'll just tell you. So for example, if you have inventory days of 30 days, that means when your goods are in finished form, you take 30 days in order to convert them into sales. So this is basically your holding period. After you have sold the goods, even after you have sold the goods, there are your receivable days. And for example, if your receivable days are again 30 days, then that would mean that first your money was stuck for 30 days in inventory. And even when that inventory is sold, it is further stuck with your customers. So you don't have the money here as well. So technically summing up both, that would mean that for 60 days, your money is stuck either in inventory or your receivables. Now, ideally, how much should be your payable days? Technically speaking, your payable days should be higher than 60. Technically, sorry, ideally, I would say in this case, your payable days should be higher than 60. If your inventory days are 30, that means your money is stuck in inventory for 30 days. Again, if your receivable days is 30, then your money is further stuck into your, with your customers for another 30 days. So for altogether 60 days, your money is stuck in your current assets. Now, how soon you should be paying your supplier? Ideally, you should be paying your supplier after you receive the money from your receivables. After you receive the money from your customers, then thereon you should be paying off your suppliers. Yeah, ideally that should be the case. Yeah, it should be greater than 60 days. But is that always possible? The answer is no. Sometimes your suppliers agree on a greater, on a greater credit period. Sometimes they don't. So, for example, if you're importing goods from somewhere, most likely your international supplier won't agree to a period of 60 days. They would ask for some sort of security that you're going to pay even after 60 days. So they would like you to pay in 15 days or 10 days. But you need to negotiate with them and agree on a principal basis that how much, based on how much credit they are willing to provide and how much you can secure. Ideally, it should be greater than 60 days, but practically you need to see what your supplier agrees on. So, sir, what would happen if our payable days is not higher than the sum of inventory and receivable days? Just think about it. If your sum of your receivable and inventory days is 60 days and your payable days become 50 days, then technically you are paying 10 days earlier than when you receive cash. So your bank account would technically be empty because all of your money would have been spent on inventory and receivables. And then you pay suppliers in 50 days, that is 10 days before you actually recover cash from your customers. So that would mean the consequence of that would be that for at least 10 days, you will be incurring additional finance costs because you will have to take overdraft in order to pay off your suppliers. So there will be additional finance cost for these 10 days if you pay earlier than the period you recover cash. So likewise, if you pay your supplier in 70 days, for example, in this case, you will be having 10 days of opportunity, and thereon you can earn some interest income over the excess surplus funds that you have. So for example, if you receive money from your customers after the span of 60 days ultimately, and you pay off your suppliers after 70 days, so you'll have 10 surplus days during which period you can deposit your money in some short-term fund and earn some interest income over it. So if your payable days are higher than the sum of inventory and receivable days, you get an opportunity to earn some interest income. But if they are lower, you have a negative side. You have to incur additional finance cost in order to finance yourself. All right. So this is basically the strategy that I wanted you to know. And if you really want to summarize whatever I told you here, a sum up of inventory, receivable and payable days, you can just jump onto another ratio, which is basically known as cash operating cycle. Now, the formula for cash operating cycle is that you take your inventory days, for example, in our example, our inventory days was 30 days. Then you add up receivable days, some receivable days. In our example, that was again 30. And then you subtract payable days. Now just imagine, for example, if my payable days are 70 days. Payable days are 70 days. When you add up, when you sum up inventory days and receivable days, that would equate to 60. Yeah. And when you subtract 70 days of payable days, you would get an answer which is negative 10 days. And this is known as your cash operating cycle. So basically, cash operating cycle ratio is the sum up, is the net figure of all your working capital ratios. And what do you actually get to know from cash operating cycle? You see, under cash operating cycle, whenever you get a negative answer, it shows a positive picture. And whenever you get a positive answer, you are looking at a negative picture. Sir, we don't understand. Can you please explain? And why not? You see, if you have a negative answer, you can only have a negative answer mathematically when your payable days are higher than the sum of your inventory and receivable days. So if you're paying on a later date, you have greater opportunity to earn interest income. So a negative answer would mean there is a positive picture. Yeah. And if the answer of your cash operating cycle basically comes positive, when would it come positive? When you have a payable days of for example, 50. So if you have payable days of 50, 30 plus 30 is 60, minus 50 would mean that you have an answer of 10 days positive. So positive answer would basically reflect a negative picture, because that would mean your payable days are less than the sum of your inventory and receivable days. And that would mean that you're settling your supplier earlier than you receive your money from your customers. And that would mean you would have to incur additional finance cost in order to finance your operations. Yeah. So it's basically a sum up of all working capital ratios, whatever we discussed on the last slide. Now your examiner can ask you anything, even if if your examiner does not ask you for cash operating cycle, during your commentary, you can easily include a cash operating cycle and make a basis for your conclusion and say that, you see, our cash operating cycle is positive or negative, and that would be affecting our liquidity in the shorter run. And if your inventory days or receivable days, for example, are higher, there is a high chance, there is a high risk of obsolescence, or there is a high risk of turning on bad debts, and that could eventually affect profitability in the longer run. And that is how you appraise based on working capital ratios, and that is how you comment in your answer papers, in your question papers, in your respective papers. Yeah. So this is very important for you to have an understanding of this. All right, moving on. Now we have some investor ratios that we need to discuss. So at least we are going to discuss 3 investor ratios here. Now there are multiple investor ratios in totality. There are approximately 5 investor ratios that you see throughout your ACCA scores, but at least 3 of them we are going to discuss right now. Yeah. So when we talk about investor ratios, you need to understand that why we are actually assessing our company based on investor ratios. What is this category all about? Now, when you are studying investor ratios, you have to take an investor's perspective. Yeah. So it's not about your operations anymore. It's not about the fact that you had some uncontrollable factors that affected your business's profitability. It's not about controlling or uncontrolling. It's not about appraising the company's management only. It's all about that how, what is going to be the perception of your investor when he sees your financial statements results. Yeah. So it's all about having an understanding that whether the company for an investor is viable or not. Yeah. So when I mean investor, I'm talking about your equity investors, and I mean your shareholders. Yeah. So one of the most basic ratios is earnings per share. So earnings per share, what is the formula for earnings per share? The formula for EPS or earnings per share is that you take on your PAT, that is profit after tax, and you subtract any preference dividend from it. And then you divide that, your numerator, from number of ordinary shares. I mind you, this is number of ordinary shares. Now, just have a look at what you're actually doing here. When you take profit after tax minus preference dividend, you see, profit after tax is the final profit that you are left with once you have paid all your debt holders interest and also paid your taxes. So technically speaking, all of the money that you're left with, all of the profit that you're left with should belong to your shareholders. Yeah, you have paid off your debt holders, you have paid off government, you have paid off everyone. So technically, whatever money you are left with should belong to your investors, your equity investors. Then the formula asks that you should subtract any preference dividend from your profit after tax if there is given in your question. Now, when you are done with subtracting the money of your preference shareholders from your profit after tax, that means that you are left with the money that is solely attributable to ordinary shareholders. So if some student was to ask me that, sir, what does your numerator mean? My numerator in this ratio basically means that what money we are left with, which is solely for ordinary shareholders after subtracting any dividend that is due to your preference shareholders. Now, once you have all your ordinary shareholders' money in the numerator, you should divide them by ordinary number of ordinary shares so that you get to know what amount of income your ordinary shareholders are actually getting. So for example, if you get an answer of $2 per share, this would be interpreted as that on each share, my shareholders have earned $2 this year. So EPS basically means that what amount of income the business has earned from a shareholder's perspective, how much money that is he left with during the year. So technically speaking, from an investor's perspective, the answer of earnings per share should be as high as possible. Now, sometimes it can go low due to some one-off expenses, but largely the higher the EPS, the more motivated your shareholder is going to be because he would be earning a lot more. Now, you need to always compare your EPS with those of your competitor and your industry averages. Because if your investor is not earning, par to what industry is earning, your investor won't be happy with the management. Your investor won't be happy with the company. Most likely what your investor would be trying to do is that he would pluck out money from your company and invest in some other competitor company so that he can earn more money. So if your EPS is falling and it's below par of industry average or your competitor, your investor won't be happy, and most likely he would demand a change of management or something like that. So in order to keep your investors happy, your ordinary shareholders happy, remember they are the ones who can vote in an AGM. They can kick the board of directors out. They can take strategic decisions. They are the real owners of the company, the risk takers of the company. So you need to make sure that these are those stakeholders that you need to keep happy. So an EPS should be as high as possible. Yeah, it all depends what amount of profitability the company is earning. Obviously, lower profitability would lead to lower earnings per share and your investor is not going to be happy. Now, whenever you are commenting on EPS in your exam, you need to take an investor's perspective and talk about the fact that either your investor is going to be happy or not while looking at your results. Yeah. And what are going to be the major concerns of your investors? Is your investor going to say, oh, you haven't earned despite the fact that the market was growing? If your investor is going to be saying that, you look at the industry averages, you are earning way less than what your industry is earning. So you should be prepared. Management should be prepared for these type of questions from investors. Yeah. Now, one of the other ratios that I need to connect with EPS is basically price to earnings ratio, or in short known as the PE ratio. Now, the formula for PE ratio is that you take on market share price in the numerator and divided by earnings per share. Now, it's always said that price to earnings ratio reflects the confidence of your shareholder. Price to earnings ratio reflects the confidence of your shareholder. And how do you interpret so? So, for example, if a company's EPS is, for example, $2 and the market price of your share is $1, $4 divided by $2 would give you an answer of 2. And this ratio is written as 2 times. Now remember, any answer which is greater than 1 reflects higher confidence of shareholder. Sir, what do you mean? How do you basically interpret that? How do you come to this conclusion? Because technically speaking, if your company earns $2, it should have a market price of $2. You see, anything is valued based on what it earns. So if this is a pen and it can earn you $2, you should only be buying this pen for $2. It's as simple as that. If this pen can only earn you $2, why would you be paying $4 for it? It doesn't make any sense. The maximum price of any commodity, anything, should be the maximum amount of economic benefits that you can extract from that particular asset. Yeah, doesn't it make sense? But you see, if your share price is $4 against for a company which is earning $2, that would certainly mean that your shareholders have high confidence on the future profitability of the company. And despite the fact that the company is now earning $2 only, your investors in the market are willing to pay even $4 for this type of a company's shares, because they are confident that the profitability will grow in future. So they are basically betting on your company, they are betting on your ideas, they are betting on your product, they are betting on management, and then they are saying that, you see, we have 2 times confidence in your earnings, and we are sure that you're going to increase your earnings by a mile in the future years. And that is why they would be paying $4 even for a share that earns $2. Yeah. And likewise, if there is less than one answer of price to earnings ratio, that would mean less confidence of your shareholder. So for example, if your EPS is $2 in the denominator and your share price is $1, the answer would come as 0.5, and you would write it as 0.5 times. And this literally means that your investor is having half confidence in your earnings, and he is not very optimistic for the future. And that is why he is saying that I would only pay $1 for a company who's earning $2 right now, because he knows that when he'll buy the company, the future is not bright, and therefore he is going to have losses in future. And in order to compensate him, he is only willing to pay $1 to buy this share price, because the future is not bright. So any answer which is less than 1 means less confidence of shareholder, and any answer which is greater than 1 means high confidence of your shareholder. Yeah. So you need to interpret this PE ratio in the same manner in your exam. Look at the PE ratio's answer if it's greater than 1 or less than 1, and then come to a conclusion that why would this be happening. You can compare with industry averages or your competitor, and then conclude if your shareholder will have high confidence or low confidence in your company. Yeah. The other ratio that I want to discuss with you is dividend yield. Dividend yield. Yeah. So basically, yield means return or output from something. So when the word yield is used with the word dividend, that basically means that what is the actual return of the dividend for the shareholder. And you'll better understand when you see the formula of this. So the formula for dividend yield is market price per share in the denominator and dividend per share in the numerator. Market price per share in the denominator, dividend per share in the numerator. Yeah. And what does this actually mean? So for example, if your market price of each share is $10 and the dividend that your company is offering is $2, this basically means that you have provided 20% return to your shareholder. So if an investor actually buys 1 share of your company for $10, and in exchange after 1 year you pay him off $2 as dividend, technically he has earned 20% return on his investment. So the value of this $2 dividend is only 20%. You cannot say that you are paying 100% $2 dividends to your investors. For an investor, if they are spending $10 in terms of market price of a share, when they get dividend, they make a relation of the market price and the dividend, and they see what is the real worth of that dividend for them. So a 20% dividend yield would mean a 20% return for them. Yeah. And technically, obviously, it's fairly obvious that dividend yield should be as high as possible. The more dividend yield you have, the happier your investor is going to be. That's more of a common sense point. Yeah. But sometimes what can happen is that you might have paid a good dividend this year. For example, you paid $2 dividend this year, and last time you paid $1 dividend only. So basically there is an 100% increment in your dividend that you're paying this year. But optimistically, your market price has increased a lot this year because your shareholders are very confident in the future of your company. Yeah. So that could eventually lead to a lower dividend yield, but that would not be bad. You need to actually assess that what you're putting in the formula this year and the last year. So for example, in X1, dividend per share was $1, whereas your the share price was $5. This would give you an answer of 20%. And this year you get a dividend of $2, but your share price has somewhat jumped to $20. Your dividend yield would come as 10% only, and you would be thinking that, oh, this is bad performance. But you also need to look at the denominator. Yeah, you also need to look at the denominator. That's right, that your dividend yield has decreased, but your investor would have been compensated by the capital gain. The share price increased, and that means your investor would be having capital gain, and your investor would have been compensated by the capital gain. So please have a deep down look at your ratios whenever you are calculating them, and respond to the examiner accordingly. That is part of the whole deal. All right. So with this, my friends, we conclude investor ratios here. I hope you understood them very well. And I'll just to close this topic, I would like to discuss, one area which is highly examined in your exams. And these are very easy marks that you should not be leaving. And this is basically your investors, your examiner regularly asks you that what are the limitations of ratio analysis. And we'll have a discussion on it very briefly. You see, the first limitation of your ratio analysis is that this is basically a retrospective, a past examination. It is a retrospective. Retrospective means past. So you are basically performing a past examination. Yeah. Whenever you calculate ratios, those are based on financial statements for the historical period, for the past period. So a ratio can only help you to assess what happened in the past. It cannot help you determine what is going to happen in the future. So it's not forward looking, it's rather backward looking. This is one of the limitations of ratios. Remember that your financial statements are always affected by accounting policies, whether you opt revaluation model or you don't opt revaluation model, whether you opt fair value through P&L model or fair value through OCI model. So the choice of accounting policies always affect your financial statements, and likewise they always affect the outcome of your ratios. Yeah. So for example, if a company A has the model of mark to market, fair value through P&L, and the market is rising, they will have fair value gains in their income statement. And let's take an example. There is a company B, which is the competitor of company A, but it has fair value through OCI selected as an accounting policy. They would also be having gains, but that would have been booked in OCI. And hence there would be no mark to market gain in their P&L, and so they would be having less profitability, and company A would be having high profitability as they are used to booking their fair value gains in their P&L. So this makes the comparison somewhat manipulative. This makes the ratio analysis technique more difficult. Yeah. So the ratios do get affected by the choice of accounting policy of the respective entity. Yeah. Likewise, ratios can be manipulated by just tweaking your accounting, but just by tweaking your financial statements, increasing provisions or decreasing something, or deferring your revenue or preponing your revenue. You can, somewhat affect your financial statements if they are not properly prepared, and that can manipulate the ratios as well. Yeah. Optimum benchmark varies from industry to industry. Yeah. So in today's time, many of the industry have their own ratios. For example, banking industry have their own ratios. Those are specialized ratios. Even they are such specialized that they are not even in the course of ACCA. So for every industry, there are different ratios that you need to discuss. So the ratios that we studied are not wholesome. The analysis varies from industry to industry. One-off transactions may affect comparison. Yeah, if there is a one-off transaction in X2, you would not be able to compare the results of X2 with X1 just due to some one-off transactions. Some high gain on disposals or some abnormal legal cost or something, fines or penalties that would affect your current year financial statements, but not your previous year's financial statements, and hence the comparison would be more difficult. And remember, one shoe cannot fit everyone. These are some standard ratios that can be generally applied. But again, in today's time, each and every industry have developed their own ratios. You cannot just judge them on basically some standard ratios, some booking ratios, some bookish ratios. And these are some of the limitations that you need to know from your examination point of view. We'll be discussing more limitations while we are doing some past papers, but at least you have some basic idea of what can be the limitation of ratios. Yeah. So take care. I'll see you next time.